All right, everyone. Marco Palmero, founder of Ulysses in Dubai, and welcome to another episode of Acquisition Case Studies, where we take deals that we sourced and negotiated in the past, we analyze them, and we extrapolate some of the lessons that I took away or my team took away from being involved in that particular transaction. Of course, I'm always going to talk about deals that we have been involved in, either directly or indirectly, because we were buying the business ourselves or because we were supporting a client in buying that asset. This series of video is, of course, focused on the key objective of navigating the Middle East situations and problems that might happen when doing deals. And hopefully it can provide entrepreneurs, business leaders, and private investors with some guidance, especially if you, as one of these people, are thinking about buying assets here in the region. So this time we will go over a deal that we got offered about 16 months ago, which was a partial sale of a portfolio of assets. And it wasn't really a private equity group offloading assets. It was more like a group wanting to divest some of the locations that they had. Now, we thought that could be a good opportunity because not all times companies divest assets because they're not good for them anymore. They might just change their focus and their objectives. And as a consequence, the board decides to get rid of particular businesses that might be super profitable, but might not be the focus of that organization anymore. And the reason why that is very interesting is because you can potentially get companies for a steal, because these guys need to get rid of these stuff, I don't know, by the end of the year, and they don't care how much they get for the business, provided they accomplish the result of selling it. So we've thought that deal was interesting on paper, of course, and we decided to sit down with these guys. Now, I'm going to give you the 5 key parameters, 5 key points that we always look at when discussing a deal. The transaction itself, the group itself had been around for about 20 years, so it was a very stable group in the region. The staff across the entire group was probably over 1,000 people, with 200 of these people being the key personnel. Now, they didn't have any real estate associated to the business, and fundamentally they had about, if I remember correctly, about 8 locations in total, maybe a bit more than that. It could be around 10. But the point isn't how many locations they had. The point is, why were they interested in selling this specific location? Based on the reasons they gave us in the first couple of meetings, their kind of like strategic focus had changed, which is what I mentioned to you before, right? So they were focusing on new markets. They were targeting a narrower geographic area, and as a consequence, this asset didn't fall into their geographic area anymore. Now, as we checked the brief and the investment memorandum they had on the business, we also saw that the company wasn't really that profitable, because it was a business generating $20 million a year in revenue, but just profiting about $500,000 in revenue. So half a million in profit. I'm sorry. So from the get-go, the deal didn't sound so good for us based on the criteria that we follow when buying businesses. But I think the lesson I took away from this was a point that came out during the conversation. And the point was the fact that this group said to us, we have changed our goals and objectives, so we focus on different geographies. But the reality was they were just trying to consolidate their group and focus on the assets that were generating cash, while at the same time getting rid of the ones that were not performing and potentially cash in and bring in some money for them. So that came out after a series of conversation, because coincidentally, as we were having these meetings, the board of directors appointed the chief restructuring officer to the business. And the guy, the moment he stepped in the office, had a meeting with us and said that he was, engaged and hired to fix the financial situation of the company. And the reality of it wasn't that they had new objectives or they wanted to focus on different geographic areas. The reality was that they realized they were spreading themselves too thin, and there were some assets that were performing very well, others that were performing shittily. So they decided, okay, we're just going to stick to the ones that work. We're going to get rid of anything else, and hopefully we can get some money for it. And so that was their rationale. Of course, initially they never said that to us, because it would have been like killing themselves. But that's what came out after. And I think that is an important lesson, because sometimes we might, as a buyer, be interested in assets that appear to be very good deals or a steal, but we don't realize that these assets might be more problematic than we think. And in this particular case, that was exactly the case. It wasn't particularly difficult to see that this asset was not one of their top performing ones, because it was almost break even. But in other cases, I've seen situations where the assets are performing and the guy is offloading them. And so you wonder, why is it offloading such a good asset? And then you realize there might be problems that are happening in the business, some change in regulation in that specific geographic area, and all these sorts of stuff that you might not be aware of that can compromise that deal if you buy it and if you then start operating it. So the big lesson I took away from it is that if a big group is offloading assets, you always need to dig deeper into the reasons why they're doing it. If they're a private equity group, I would have probably thought about it in a little bit of a different matter, simply because sometimes private equity groups decide to offload that either because they need to pursue other interests, or the lifetime, the time span of the investment is coming to an end, so they need to cash in and give returns to the investors. So in that particular case, assets might be better opportunities because they're gonna be forced to sell anyway. But in all other cases, when I'm talking directly with owners that are running these businesses and they own them directly, I'm always thinking, well, is there something behind, and why are they offloading this particular asset at this particular moment? And in this case, that was exactly the reason. They just wanted to cash in on the unprofitable assets and then use all that capital to grow the few locations that they were actually working. And that is still the case, because to this day they're still in the process of restructuring the group. Of course, it's not something that happens overnight, but I think that's the biggest lesson I took out of it, making sure you understand the motivations of the group, and also don't buy assets that might appear good deals while in reality they're not. So that's pretty much it for this case, and I'll see you in the next one.